Okay, so you want to own a snow removal business. The pitch writes itself. Winter comes, snow falls, you show up with a plow truck, clear a parking lot in 40 minutes, and someone hands you a check. Repeat until spring. The equipment is straightforward, the skill set is learnable in a week, and the demand is literally falling from the sky. You don't need a degree, you don't need a patent, you just need a truck, a blade, and a willingness to work at 2 in the morning. Sounds simple. It is not simple. Here's the truth nobody leads with. Snow removal is one of the most financially volatile small businesses in America. The product you're selling exists only when a meteorological event that you cannot control, cannot predict with any precision, and cannot manufacture decides to show up. And when it does show up, too much or too little, the business math can collapse in ways that are genuinely hard to recover from. Every year, operators who ran profitable routes for a decade get wiped out by a single mild winter. Not from bad management, not from a lack of effort, from the weather just not cooperating. This video is about what it actually costs to run a snow removal business, what actually makes money, and the one structural vulnerability built into the business model that most people don't fully understand until it's already cost them everything. Let's start with what you're actually buying when you enter this industry, because it's not what it looks like. On the surface, you're selling a labor service. Remove snow from a surface in exchange for money. That's the transaction. But here's the reframe that changes how you see everything else in this video. A snow removal contractor isn't really selling labor, they're selling certainty. Property managers, hospital administrators, shopping center operators, HOA boards, none of them want to think about snow. They want to wake up the morning after a storm and know, with confidence, that their parking lot is clear, their sidewalks are salted, and their liability exposure is managed. They are buying the absence of a problem. And like all insurance products, the value is invisible right up until the moment you actually need it. That distinction matters because it explains the pricing structure, the contract dynamics, and ultimately, the business's biggest vulnerability. When you're selling certainty, the weather becomes your core business risk in a way that's completely unlike most industries. A restaurant can order fewer ingredients if demand drops. A landlord can find a new tenant. A snow removal contractor cannot manufacture snow. When the weather turns against you, there is no plan B. Keep that in mind as we walk through the numbers. Let's talk about what it costs to get into this business in the first place. There are essentially 3 tiers of entry. At the bottom, a solo operator starting from scratch, working residential driveways and maybe a few small commercial accounts. In the middle, a small fleet operation running 2 or 3 trucks with a crew, targeting commercial parking lots and HOA contracts. And at the top, a full commercial operation with multiple vehicles, a skid steer loader, salt spreaders, and the capability to service large-scale properties like shopping centers, corporate campuses, or hospitals. At the entry level, you're looking at a total startup cost between $20,000 and $40,000. That typically breaks down as follows. A reliable used 3/4 or 1-ton pickup truck with a commercial-grade plow attachment from a manufacturer like Fisher or Boss runs between $15,000 and $30,000, depending on the condition of the vehicle and the blade configuration. Add a commercial-grade walk-behind snowblower, around $2,000 to $5,000, because residential blowers will fail under wet, heavy snow within a season. A salt spreader runs $500 to $3,000. Initial salt inventory, bought by the pallet from a landscape supply yard, runs $300 to $500. You need some working capital for fuel and marketing. Add it all up and you're in the business for roughly $20,000 to $40,000, assuming you can finance or already own a suitable truck. Step up to a mid-tier operation with 2 trucks, a skid steer loader, and the capacity to service commercial lots. And the capital requirement jumps significantly. Industry financial models for this scale put the total equipment outlay closer to $238,000. 2 heavy-duty trucks at roughly $75,000 each. A skid steer loader at $40,000. A trailer to transport it at $8,000. Plow attachments and spreaders at $25,000. That's before you've bought a single bag of salt or paid a single employee. Here's where it gets interesting. That equipment cost is not the number that catches people off guard. It's what comes next. Before you earn $1 of revenue, before you plow your first driveway or sign your first seasonal contract, You have a set of mandatory operating costs that don't care whether it snows or not. First, insurance. And in the snow removal business, insurance is not optional and it is not cheap. The industry carries one of the highest slip and fall claim rates of any contractor segment. According to the American Slip and Fall Claims Association, there are more than 30,000 slip and fall claims filed annually in the United States and Canada specifically against snow and ice management companies, property owners, and property management firms combined. That claim volume is why insurers treat this business as a high-risk class. General liability insurance for a small snow removal operation runs around $43 per month, or roughly $520 per year, according to data from insurance marketplace Insurion. But that's the minimum. Once you add commercial auto coverage, required for every plow truck, and typically running $1,200 to $3,000 per vehicle per year, workers' compensation if you have employees, inland marine coverage for equipment, and an umbrella policy for claims that exceed your primary liability limits, a properly insured mid-tier operation is paying between $5,000 and $10,000 per year in insurance premiums before a flake falls. Then there's the regulatory layer. Most municipalities require a general business license at $100 to $500 depending on the jurisdiction. Some require a dedicated snowplow permit for commercial operations. If you're operating in a state with salt discharge restrictions, and more states are adding these as runoff from de-icing chemicals contaminates groundwater and kills roadside vegetation, you may need pollution liability coverage and specific compliance documentation. LLC registration in most states runs $50 to $500 and is essentially mandatory if you want any personal asset protection against the lawsuits that inevitably follow a serious slip and fall on a property you serviced. Take all of that together, and the pre-revenue cost structure for even a small operation is somewhere between $5,000 and $12,000 per year, purely to exist and legally operate. Now let's build out the revenue side. Because a snow removal business doesn't actually have one revenue stream. It has four, and they work very differently from each other. The first and largest stream is seasonal flat-rate contracts. This is the backbone of a well-run commercial snow operation. Under a seasonal contract, a property manager pays a fixed price for the entire winter season, November through April, roughly 5 months, and the contractor handles all snow and ice events within that period, regardless of how many storms hit. A seasonal contract for a mid-size commercial parking lot might run between $5,000 and $15,000 for the season, depending on the lot's square footage, the geographic snow averages, and the scope of services. A hospital campus or a large retail center might run $20,000 to $40,000. According to data from Plows and Mows, one of the larger managed service platforms in the industry, over 60% of their commercial clients now choose seasonal subscription arrangements, citing cost stability and service priority as the primary motivators. For the contractor, seasonal contracts are the holy grail because they convert an entirely weather-dependent revenue model into something approaching predictable cash flow. You know what you're going to earn before winter begins. That's the value. The risk is the mirror image. If a particular winter delivers twice the historical average snowfall, you're making a fraction of your per-push equivalent, but you're still contractually obligated to service every storm. The second stream is per-push pricing, primarily for residential clients. Every time it snows past a trigger depth, typically 2 inches, you dispatch and bill. A standard residential driveway clears for $30 to $75 per push. A small commercial lot starts at $150 per event. The math on a well-built residential route looks like this. 20 accounts at $50 per push. 10 events in a winter equals $10,000 for the season from those 20 properties alone. Route density matters enormously here. Clients clustered within a few city blocks let you service 10 driveways in the time it takes to service 3, spread across multiple neighborhoods. The third stream is de-icing and salting. This is where professional operators make their best per-hour margin, and it's the stream that most outsiders underestimate. A typical salting application on a commercial lot costs the contractor roughly $80 to $120 in materials and labor, and gets billed at $180 to $350. That's a margin of 50 to 75% on every application. Many experienced contractors say ice management is the single most profitable service in their entire portfolio. The Green Industry Pros trade publication reports that ice melt applications consistently generate the highest margins in snow operations, and seasoned contractors refuse to take on plowing clients who won't also contract for de-icing, because de-icing is where the money actually is. The fourth stream, less obvious but increasingly common, is anti-icing, the application of liquid brine solution before a storm arrives, chemically preventing the snow from bonding to the pavement surface. Anti-icing reduces the amount of plowing required after a storm, reduces salt usage, and dramatically improves surface safety. It's billed as a separate service, typically $150 to $300 per application on a commercial lot, and it runs at high margins because the labor is minimal and the chemical cost is low. Operations that stack seasonal contracts with regular anti-icing programs have a revenue model that looks fundamentally different from operators who only plow. Now let's talk about what it costs to run this business every day, independent of how much it snows. This is the fixed cost trap, and it is the defining financial structure of the industry. A snow removal operation has a set of costs that run continuously through the winter months, whether you deploy once or 20 times. Truck payments or lease obligations don't pause for a mild week. Insurance premiums are monthly. Salt storage, because you have to pre-purchase inventory before the season to guarantee supply and pricing, since road salt costs spike during and after storms, is a capital commitment made months before you know how much you'll actually use. Storage space or a yard for equipment has a monthly cost. GPS route optimization software, which larger operations now consider essential for managing multi-truck deployments, runs $100 to $500 per month. If you have employees, you pay either retainer wages or you lose them to other industries over the winter. Either way, the labor cost has a fixed component even when the trucks are sitting. For a solo operator running a modest residential route, fixed monthly costs might run $2,000 to $3,500, covering truck financing, insurance amortized monthly, fuel reserves, and salt pre-purchase. For a 3-truck commercial operation, industry financial models put the fixed monthly overhead at $8,000 to $12,000 per month during the active winter season. That number has to be covered before you're generating a single dollar of net income. Here's the structural problem. Revenue in this business is variable. Costs are largely fixed. When it snows heavily and often, the economics work beautifully. Marginal cost per event is low because you're spreading fixed costs across many billable occurrences, and seasonal contracts have already been paid. But when it snows once in January and twice in February, the fixed costs keep running, the per-push revenue disappears, and you're paying to stay in business while earning almost nothing. According to IBIS World Industry Analysis, profit margins for snow plowing service companies fell across the industry during 2023 and 2024 as a combination of expanding labor costs, fuel costs, and inconsistent snowfall squeezed operators from multiple directions simultaneously. That's not a bad management story. That's the structural math of the business doing exactly what it's designed to do when conditions don't cooperate. Here's the trapdoor. The thing most people don't see until it's already too late. It's called the seasonal flat rate inversion. The seasonal flat rate contract sounds like the safest, most attractive structure in the business. You get paid up front, in installments, before winter starts. You know your revenue. You can plan. And when the season runs exactly at historical snowfall averages, the math is fair to both parties. The contractor gets reliable income, the client gets a known budget. That's the design. The problem is what happens at both extremes. In a very heavy snow year, say 150 or 200% of historical snowfall averages, an operator with a full book of seasonal contracts has to service every single storm. Every storm means fuel, salt, labor, and equipment wear. But the revenue is already fixed. The seasonal contract that seemed adequately priced for 12 average events becomes a money-losing obligation when you're running 35. Operators have gone negative on individual contracts in blizzard years, and some have struggled to cover basic operating costs by March because they'd already spent the season's revenue on salt and overtime by January. But here's the inversion nobody warns you about. The really dangerous outcome for seasonal contract operators isn't a brutal winter. It's a mild one. A warm winter, say 40 or 50% below historical snowfall averages, is financially catastrophic if your revenue model depends on per-push billing. All weather-dependent, all lost. And even for seasonal flat-rate operators, there's a subtler disaster. You survive one mild winter with your contracts intact. But your clients noticed. They paid $12,000 for a season where you showed up 4 times. They go into renewal negotiations with a number in their head, and they push back hard on pricing. Or they decide to take the risk next year and go per push. Your predictable contracted revenue base erodes exactly when you need the stability most, going into the following season. And here's the external threat that compounds all of it. Winters in the northern United States are getting warmer. According to data from AccuWeather and NOAA, winter temperatures across the northern plains and upper Midwest have risen an average of 4 to 5 degrees Fahrenheit since the start of the 20th century. And that warming trend is accelerating. Analysts note there has been a 5 to 20-day reduction in extreme cold days in the upper Midwest compared to historical averages from the late 1940s. That isn't a fringe finding. It's a structural shift in the operating environment of every snow removal business in the snow belt. When your entire revenue model depends on a meteorological pattern that's measurably moving against you over time, that's not just business risk. That's an existential question. Let's look at a real example. The winter of 2023-2024 is the single most instructive data point the modern snow removal industry has produced. That winter, driven by a historically strong El Niño pattern, produced the warmest recorded winter on record across the contiguous United States, concentrated in the exact geography where snow removal is a primary industry. Fargo, Minneapolis, Green Bay, Chicago, Detroit, Cleveland. Minneapolis-St. Paul International Airport recorded less than 30 inches of snowfall for the entire season, roughly 55% of its historical average. Iowa, Minnesota, Wisconsin, Michigan, and North Dakota logged the warmest winter temperatures on record across dozens of stations simultaneously. For the snow removal industry, the impact was immediate and severe. AccuWeather's economists estimated the total economic damage and loss from the mild winter conditions in the northern plains and upper Midwest alone at approximately $8 billion across all weather-dependent industries. Snow removal companies were specifically named in the report among the businesses reporting losses. Seasonal workers were laid off. Per-push operators watched entire months of projected revenue evaporate because the trigger depths were never reached. Even operators with seasonal flat-rate contracts didn't escape unscathed, because while their current season's revenue was protected by the contract, their costs hadn't dropped proportionally, and the erosion of client confidence heading into renewal season created pricing pressure that would affect the following year. The U.S. Small Business Administration declared federal economic injury disaster loan eligibility for hospitality and snow removal businesses across dozens of counties in Minnesota, Wisconsin, and Michigan as a direct result of this single winter. This was not a fringe outcome. This was the business doing exactly what the business does when the weather goes the wrong way. And the critical point is this: the operators who got hurt worst were not the underprepared or the financially careless. Many were experienced, well-managed businesses. The warm winter was simply bigger than their business model. Let me show you the math of a good year against a bad year, because the numbers tell the story better than anything. Imagine a 3-truck commercial operation in the upper Midwest. You've got $238,000 in equipment, financed over 5 years at roughly $4,500 per month in combined loan payments. Fixed monthly costs, insurance, labor retainer, storage, fuel reserves, GPS software. Run another $5,000 per month during the active 5-month season. Total fixed costs for the season, $47,500. Salt and de-icing material inventory pre-purchased for the season, $15,000. Total baseline cost to operate for the season, approximately $62,500, before you count labor for storm deployments. Good year scenario. Historical snowfall average, 15 to 18 plow events. You've booked 8 seasonal commercial contracts averaging $8,000 each, $64,000 in contracted seasonal revenue. You do per push work on another 12 residential accounts plus de-icing billings that add another $18,000 across the season. Total revenue, $82,000. After your $62,500 in base costs and roughly $12,000 in variable deployment labor and additional fuel, You net approximately $7,500 to $9,000 for the season. Margin of around 10 to 12%. Not spectacular, but real, recurring, and compounding as the client base grows. Bad year scenario. The winter of 2023-2024 comes to your market. Snowfall hits 40% of historical average, 6 to 7 events instead of 15 to 18. Your 8 seasonal contracts still pay, $64,000 collected because the contracts are binding. But your per push and de-icing revenue collapses to $4,000 instead of $18,000. Total revenue, $68,000. Your base costs don't move. $62,500 is $62,500 whether it snows or not. Variable deployment is lower, but you've still got $8,000 in labor costs because you kept your best crew on retainer to be ready. Net result, you're at approximately negative $2,500 for the season. In your good year, you made $7,500. In your bad year, you lost $2,500. The difference between those two outcomes, driven entirely by weather, is $10,000. On a business requiring $238,000 in equipment alone, that margin range is remarkably thin. And if you came into that bad year undercapitalized, or with a heavier debt load, or having just upgraded equipment expecting the historical average to hold, that $2,500 loss becomes a much more serious problem. The only operators who sleep soundly through a bad snow year are the ones who built an integrated business model. Snow in winter, landscape maintenance in summer, where the warm winter doesn't collapse total annual revenue. According to industry data, businesses that combine snow removal with year-round landscaping and lawn care services earn nearly 3 times the revenue of snow-only providers. That's not a coincidence. That's the mathematical answer to the seasonal contract inversion problem. So why do sophisticated operators still build snow removal businesses, even knowing all of this? A few reasons that don't show up in the basic financial analysis. First, entry barriers. Snow removal sounds accessible, and the low tier is accessible, but operating at the commercial scale that actually generates meaningful income requires capital, equipment, certifications, and, most importantly, relationships with property managers that take years to build. The Snow and Ice Management Association offers a certified snow professional designation that has become a meaningful signal to commercial property managers evaluating contractors. These barriers mean that once you've built a commercial book of business with multi-year seasonal contracts, you're reasonably protected from low-cost entrants who just bought a plow truck. Second, the private equity thesis. According to industry acquisition specialist CT Acquisitions, which tracks M&A activity in the space, established snow removal businesses with proven contract books are trading at 4 to 9 times EBITDA for pure snow operators and 8 to 11 times for integrated landscape plus snow operators. Private equity platforms, Brightview Holdings, Yellowstone Landscape, Heartland, Sensky Services, Shill Grounds Management, are actively rolling up regional snow operators across the snow belt. The reason is scale economics. Route density, shared equipment, and centralized logistics turn a marginally profitable local operation into a significantly more profitable regional one. A small operator with $300,000 in annual revenue isn't getting rich. A platform that aggregates 40 such operators across Ohio and Michigan absolutely is. Third, tax treatment. Equipment in this business depreciates quickly, and the IRS allows Section 179 deductions that can offset significant income in the early years of ownership. A well-structured snow removal business, particularly one integrated with a landscaping operation that generates year-round income, can produce meaningful tax sheltering benefits that don't appear in the headline margin numbers. Let's come back to where we started. A snow removal contractor isn't selling labor. They're selling certainty. That's the product. But here's what that reframe really means in the long run. The business's entire viability rests on whether the weather cooperates enough to make that certainty worth selling in the first place. When it's cold and snowy, consistently, the way the northern Midwest was for a century, the business is a machine. Recurring seasonal contracts, stacked with high-margin de-icing, on dense, well-optimized routes, generate reliable cash flows that compound quietly year after year. The operators who built this in the 1990s and 2000s built good businesses. The variable nobody fully priced in was climate. The winters that the industry built its pricing models, its contract terms, its equipment financing schedules, and its seasonal revenue expectations around. Those winters are measurably changing. Not catastrophically, not uniformly, not linearly, but the trend line is clear. Fewer extreme cold days. Lower average snowfall in many snowbelt markets. More volatility, not just in quantity but in timing. Late starting seasons that disrupt contract deployment. Early thaws that reduce the event count even when total precipitation is adequate. This doesn't mean snow removal is a dying industry. It is a $15 billion annual services market in the United States alone, growing at roughly 4 to 5% annually, according to market research published in 2025. The demand exists because the liability exists. Slip and fall lawsuits don't go away when winters warm slightly. If anything, the unpredictability of modern winters, the polar vortex events, the sudden late-season blizzards, the warm stretches followed by flash freeze, makes professional ice management more valuable, not less. But the business that works going forward looks different from the business that worked before. It's integrated. It's diversified across multiple revenue streams. It has seasonal contracts that are priced for volatility, not for historical averages. It has a balance sheet strong enough to absorb a bad year without wiping out 3 good ones. Here's the thing nobody tells you when they pitch you on the simplicity of snow removal. The snow is the easy part, managing a business that lives and dies on whether 40 million acres of atmospheric moisture decides to fall as precipitation between November and March, in a world where that pattern is quietly, persistently, measurably shifting. That's the real work. The plow truck is just the beginning.